Welcome to the PI World interview on the 15th of April 2021. And today I'm delighted to be joined by Rosemary Banyard, Fund Manager of the VT Downing Unique Opportunities Fund, which was launched last year on the 25th of March 2020, just a few days off the low of the market crash. Rosemary, thanks so much for joining us. Tell us a little bit about your background.
Pleasure, Tamsin. My background. So I spent about a decade in sell-side research, and then I did a part-time MBA while having children, and I then moved on to being a fund manager. And after a couple of years, I was recruited by Andy Brough to work with him at Schroders. And over the succeeding 18 years, he and I built up a very significant book of business in mainly small and mid caps in the UK, a little bit of all caps. So that was a great time. I think at the end of that, I decided I needed a new challenge. And I was a bit stale, and I wanted to do something completely different. So I went from very large firm to very small firm and joined Sanford Deland to work with Keith Ashworth-Lord. I was a director and I launched a fund called Free Spirit, which went well. But sadly, it wasn't the right place for me. So about a year ago, as you say, I moved to Downing and did the same again. I launched the Unique Opportunities Fund for Downing pretty well at the bottom of the market.
So what inspired the VT Downing Unique Opportunities Fund?
I'm keen these days to run a very concentrated fund, if you will, conviction fund. So we've got 25 to 40 holdings as the range and currently about 30. It's not exactly all cap because I've limited it a little bit at the bottom and top ends. But it's certainly wide-ranging in its the opportunity set that it can invest in the UK market, and including AIM. And it's really about picking some really excellent businesses and holding them for the long term and letting them do their stuff.
And what motivated you and why do you think it's different from anything else out there?
Two questions there. So in terms of motivation, I enjoy investing. I've been enjoying it for over 25 years. I still enjoy it. I therefore am keen to keep doing it. And it's really probably as simple as that. In terms of why it's different from anything else out there, I think that's quite a hard question to answer in a very competitive market. I think generally there are some funds out there who, like me, look for businesses with high returns on capital, high returns on equity, lots of barriers to entry, good long-term prospects. But I think quite a lot of those funds, and some of them are very well known, do focus very much either on bigger companies or indeed on more global range of companies. So I suppose if there's anything different about this, it's that it's focused on small and mid caps.
And how's it performed in the first year? Because it's the first birthday we just passed.
Yes, indeed. So it's helped by the fact that, as you pointed out at the beginning, it launched virtually close to the low of the market. And in the first year, it's up something like 55%.
Wow.
that has been achieved with quite high average cash balances. Of course, I started with 100% and took my time to invest the money. So the underlying performance of the holdings is rather better than that.
And what was the average cash balance throughout the year?
It was over 20%.
Right, okay. And how did it feel launching a fund during the nadir of the March crash when there was fear all around?
Yes. Well, it's interesting, isn't it? Because the market went down, I think something like 30% in a few weeks, and then it didn't stay down for very long. And so, one has to think back to what was it really like. And actually, it was quite scary in that there were two classes of units, and so the income units happened to launch a week before the accumulation units. So they launched on the 17th of March, and I think the market bottomed sometime in that week. So at the time of launch, it felt like catching a series of falling knives. The market was very jittery, and so I remember thinking, well, I've got my list of preferred stock ideas, and when you launch, before that you go to the regulator for permission, and they ask for a model portfolio. So the model portfolio was there, and that was what I was using, I remember thinking, well, I'm going to start cautiously because we don't know how long this is going on for, or how grim it's going to be. So I'm going to start by buying the companies on the list which have enough cash on the balance sheet to pay one whole year of all their costs, even if they had no revenues for a whole year. I knew they would survive, and that probably gives you a sense of how difficult it felt right at the beginning.
And how quickly did you get invested? You said you had 20% on average throughout, but how quickly did you get up to 80% invested, having started at a standstill mid-March?
Yes, I think it was 3 or 4 months to get to the 80%, which is the minimum requirement, obviously, for a UK open-ended fund. You have to get to it within 6 months of launch, and I definitely did it sooner than that. Actually, I think I had something like 25 names in within about 2 months, but they weren't full holdings. So I knew which names I was putting in, and that didn't change very much. But it was really the pace at which that I was investing that was perhaps cautious. In hindsight, too cautious, but that's hindsight.
So retrospectively, what would you have done differently?
Actually, I can honestly say I wouldn't have done anything differently in terms of the names of the companies. But in hindsight, I should have gone a bit quicker.
So have you sold anything since the fund launched?
Well, very little. Very early on the original list, there was a company called SSP, which is involved in restaurants at airports and railway stations, cafes and sandwich bars, whatever. They raised a bit of money. A lot of companies did raise money in the early months of the pandemic. But I thought, I think that travel is going to take an awful long time to get back to normality. And I think that's proving to be the case. They raised a bit of money, but they've now come along and needed to raise an awful lot more because of the duration of this problem. And one of the metrics that I look at as a key metric is return on equity. So if a company is having to issue, an awful lot of equity to stand still, basically, that's not so attractive. And So anyway, I sold a very, very small holding at a small profit early on, and I haven't regretted that. The other thing that I've sold quite recently, and for a different reason, is Aviva, the software company. I said earlier that I had placed some parameters around this new fund. And one is that I'm not going to invest in anything below about 150 million market cap. And that is because Downing have a big microcap business, and I just don't want to sort of tread on toes there. And it's better to be the next stage up. And at the top end, I have said I'm not going to hold companies with a market cap of over approximately 10 billion. And that's to the point earlier about not really wanting to run a sort of mega cap fund. There are, plenty of people who invest in Diageo and, Relics and some excellent, very large businesses, Unilever. And Aviva has had a rights issue to buy a business in America, and it's gone through the 10 billion mark. So I'm recycling that money. But generally, Tamsin, you should expect reasonably low turnover here. My explicit time horizon for investment is 5 years plus, and turnover should be fairly low.
And you've got a fairly Buffett-like approach to selecting investments. You've outlined some criteria that you look at, and I know you use discounted cash flow to decide a valuation. But how large a part does intrinsic value play as against other metrics, and then as against qualitative factors? What's the sort of order of priority for you?
Yeah, so the first thing I look at is the business, how it makes money, what returns on equity it's making. And in that, I'm not wanting to invest in companies with a huge amount of debt. So private equity do that. They gear up businesses hugely, make good returns on equity. That's not what I'm interested in. I'm interested in a good return on operating assets, if you will. And so I'm looking for that. I'm looking for it to be reasonably consistent over time, or if it's a bit cyclical, that at least in most of the last 10 years, or a reasonable number of the last 10 years, it's been good. And to me, that says that the business has got capital discipline, hasn't paid silly prices for acquisitions. And it also says that it's got something about it which is keeping the competition out for a long period of time. So that's the fundamental thing I'm looking for. And if, for example, I look at a business which has had good returns, but they've been deteriorating, and it could be because their margins have been falling, or it could be because they've been paying silly prices for acquisitions, then I stop at that point, and I stop working on it. The work is not wasted, but it's sort of not of interest. So that the fundamental thing is to find these businesses with good returns, and to be able actually to understand what the barriers to entry are. One of the things that came up before launch was that the regulator actually said, well, you're going to use the word unique in this fund title. What do you mean by unique? And so I explained that these were companies with very superior returns, and they were likely to be either the only one in the market, UK market, or one of very few, and with a very distinctive culture. And one of the things that came out of that was that I'm required by compliance to, whenever I'm going to put a new holding in the fund, to set out these things, what the return on equity is, what the barriers to entry are, and all that. So that's quite a good discipline. because it makes me do it. And if I can't state that pretty easily in a paragraph, then I shouldn't be investing. So that's all the crucial thing. And then you asked about intrinsic value. So this is the the Buffett and his investment school concept that a business has an intrinsic value, which is related to the future cash flows discounted back to the present day. And I do calculate that, and my calculation is quite conservative on a number of fronts. So then I get a valuation which gives me a sense of the absolute value of the business. And if I can buy into it close to that, I'm happy to do that. It doesn't have to be below it, actually, because I think it's conservatively constructed. So that is important. And then the qualitative factors. I think the quality comes out in those in the returns, in the margins, in the conservatism of the balance sheet, and in the barriers to competition.
And in the intrinsic value, what are you discounting by? What percentage do you use?
So I use 10%. It's a nice round number. I think, well, at the moment, with interest rates so low, it looks pretty conservative. There are the other aspects of the conservatism are, firstly, that I try and be conservative on my forecasting for the business, for its revenues and profits, margins. Also, beyond the explicit forecast period, which is 3 years, there's a fade down to perpetuity growth rate of free cash flow of 3% per annum. And I think for a lot of these businesses, that fade rate's conservative because they are achieving, and I believe will continue to achieve higher growth rates than in that fade. And the third thing that's I think is conservative is that these businesses generate lots of cash, and I don't assume in my modelling that they reinvest that cash. It's just it's assumed that it builds up. So I think on a number of counts it's conservative.
So looking at your holdings, the valuations look quite stretched by comparison with the quality and the momentum, which both look very good. I think that the average PE is about 45 across the holdings that I know. Are you expecting the earnings upgrade to justify the valuations?
Yeah. So it's interesting. I don't look at the PE as a metric. I do look at, as I said, the intrinsic value, and I'm aware of the free cash flow yield because the thing that comes out at the bottom of my models is the free cash. And so I'm not making a judgment based on the PE at all. I mean, some of them may, of course, be high because they are in a recovery year after a previous year. I don't know. I think that the market, if there is any inefficiency in it, arises possibly from the fact that in high return businesses, the market struggles to value them correctly because the PEs normally look only a year or 2 years ahead. And if you can sustain high returns as a business for year after year after year, a high PE for a year or two doesn't capture that. So I think in an ideal world, what's going to happen is that my businesses are going to deliver another good year, good returns. You'll roll on a year. You'll then add in a New Year's forecast, which will be higher than the one that's dropped out. And then your intrinsic value will start to rise up. That's the theory. Obviously, in practice, it will vary, but that's how it should work.
And if the market gets carried away with itself, so the valuations do get a bit stretched against the intrinsic value, would that cause you to sell, even if it's got all the other qualities that you really like in a business? Or is it then just a hold, but you wouldn't have bought it if it was this valuation, if you didn't hold it in your portfolio?
I think it's more the latter. In that I'm reluctant to sell out of good businesses with good long-term market potential just because they have got ahead of their intrinsic value at a particular point. I mean, that will happen. Shares will trade sometimes above intrinsic value and sometimes below it. And I suppose the where I'm going to add to companies is going to be to try and add to holdings when they dip below it for some reason. I've got now of the order of 9-10% cash in the fund. So I'm not at the stage of really saying, well, if I want to buy this new idea, X has got to go. Now, that could come, but it's I wouldn't see that being a major element in the fund. There are lots of good businesses, but then when you narrow that down to good businesses that you know well, that I know well, it's a smaller list, and so I want to stay within my circle of competence.
It sounds like it needs to be quite a catalyst for you to sell. You're more likely to hold for your 5-year period. But what would change your mind? What would force you to sell?
So the big ones would be if a company started to become highly acquisitive. And that could be either in terms of numbers of deals or size of deal, particularly if the management and the company hadn't had a history of acquisition. So there are some businesses in the fund where they regularly make bolt-ons, and they know what they're doing, and I'm comfortable with that. I'm not talking about those. I'm talking about a company where they suddenly say, "Oh, we're going to make a strategic acquisition to enter America or something." Alarm bells start to ring. So that's one. And the other one is if the returns on equity start to drop away. So the marginal return on equity over 1 year or 2 years starts to deteriorate. The return on equity, as it were, on the new capital. And I don't particularly worry if it's 1 year. Particularly last year, a lot of people's returns declined for obvious reasons. But if there starts to be a trend of a decline, it might be okay. It might be that they've allowed the cash to build up, and so that maybe that they're about to give out a special dividend, and that will sort that out. But if it's declining because the margins are declining or the asset turn is deteriorating, then that might be a reason to sell, because their competitive position is in some sense eroding.
And with return on capital, what percentage are you looking at?
I specifically look at return on equity because I'm an equity holder. So I want to see double figures in a normal year, and really a minimum of 13%, 14%, that kind of area, without too much debt.
And when you buy into a position, if you take a 5-year view, what average percentage increase in capital are you expecting to achieve with that particular holding?
Well, I don't know what they're going to deliver, but I think the implicit return is 10% per annum.
And you've mentioned that you're looking to have between 20 and 45 holdings in the portfolio. What's the sweet spot of number of holdings, and what sort of weighting do you like? Is there an upper threshold and a lower threshold that you look at?
Yeah, so 25 to 40, I've said I'm kind of in the middle there. I think the middle feels about right. The reason for not wanting to really go towards 40 is that the monitoring challenge gets, harder. The more holdings you've got, the more you've got to keep a weather eye on. So I think there is a sweet spot in the low 30s, probably. I think that going lower, well, there are lots of studies that, you can have different people have different opinions on it, but it will perhaps expose the fund to more stock-specific risk or maybe sector risk, general risk, concentration risk. So, I think the low 30s is the sweet spot. In terms of positioning, my sense is of a fairly flat structure with all the holdings being, say, in the 2 to 4% range. And the only reason for having less than 2% is because it's a new holding and I've just started building it, or it's a holding that's leaving and it's about to go. But I'm not thinking that I want a whole lot of holdings that are 5, 6, 7, 8, 9%, and then a little tail. Clearly the rules can put you into difficulties if you have some big holdings at the top end. You might become a forced seller if you're not careful, and that's not a good position to be in. But also, all these companies are companies that I really like, and I don't think I can forecast in any given year or few months ahead which ones are going to do well and which ones aren't going to do well, because that will depend on market sentiment, which may change at the drop of a hat. So, I don't sit there and think, X is so cheap that I want it to be, 6, 7, 8% of the portfolio because I'm just convinced it's going to double. And nor do I think, I'm Y is going to be 1% because it's so overvalued that, I don't want to lose it completely. I don't think I've got the ability to make those calls. I think the market does what the market does in short term.
And what's the maximum size a position can be under the rules of the fund?
Well, 10% for an individual stock. If you had a stock that it was 8 or 9% and you suddenly had a big market move, you could find yourself being forced to sell, which wouldn't be the ideal scenario, I think.
And of your holdings, what do you think is the most undervalued?
Well, as I said, I don't exactly think that way. There's also a sense in which if I thought something was really undervalued, Tamsin, I probably wouldn't tell you because I'd be trying to buy more. But there's a company where I think there's potential undervaluation because there's a benchmark to judge it by, which is Elementis, which is a specialty chemicals business, which has had some elements of its activities hit, particularly with COVID and cyclicality. So they, for example, they provide some chemicals to aid the production of oil and gas. and that's been depressed. They also have a business selling chromium, which is used in applications such as automotive, which has been depressed. But they also have a business which is unique, which is called, they've got a mine which mines a substance called hectorite in America. And hectorite's used to aid the flow. So if I say to you, it's used in things like lipstick or nail polish to make these products flow better. And so and they have the only significant large scale mine of that product. So, and they've got, I forget, but it's 50 years life or more. And Elementis had a bid from a competitor in America a few months ago at 130p a share, and the board and shareholders rejected it, and they went away. But it seems to me that is in some sense an underwritten share price. The shares are trading around that level, and obviously a trade buyer will possibly have some cost savings which can enable them to bid that, but also you'd hope that they were trying to bid low and take advantage of the COVID-inspired downturn. And so I think it's, there are reasons for thinking that one is undervalued for that reason.
And what's its return on equity? I think it looks about 5% to me.
Last year it would have been at that level. But as I've said, I look at the last 10 years and what it's been every year. And in something like 7 out of 10 years, it's been over my 13, 14% mark, 15, 16, I think.
And you see it going back there?
I do. Yeah.
And of the portfolio, what do you think is the most risky?
Yeah, so risk is an interesting question. Define risk. So the financial community is encouraged to define risk as volatility. I think if you're a wealth manager, that's how you principally define it. For me, the two, as an investor in the fund, actually, the two risks I more worry about are the risk of permanent capital loss and the risk of inflation. If we take capital loss, then my sense is that if you've got companies with barriers to entry, hopefully they can continue to trade well. And most importantly, one wants to steer clear of companies with too much debt. And I have approximately only six companies in the fund with any debt at all. The other risk is inflation. And I think there, if you've got good returns on equity, it suggests that you are better equipped to manage a rise in inflation. That for example, your asset turn is fairly quick. So if prices are moving up in the supply chain, pass it on. So I'm hopeful that the two risks that I define are low. In terms of high debt, maybe James Fisher, which has had some issues with poor deployment of capital for a year or two, but is rectifying that. But they need to they need to sell some poor performing assets and get the debt down. I'm hopeful that they will, but it's probably one of the riskier ones.
And which of your holdings is a buy and forget?
Well, I think Impax Asset Management, which is doing brilliantly as a business, because of the immense interest now in sustainable investing, which is their entire focus. And it's performed very well, both as a share, but also as a business in the last year. And it's winning lots of mandates. I mean, it's got some retail product, which is seeing inflows, but it's also been winning quite a lot of institutional mandates. And I feel that that trend will continue, and that their credentials are very good because they've been focusing entirely on this for the last 20 years. And so I think tuck it away. You probably don't need to look too much at it, and in 5 years' time, it'll be a lot bigger business.
Now, you've obviously been in the business for many, many years. Do you get your ideas just from being in the business for as long as you have? Or where do your ideas come from?
So I think one of the great advantages of being at Schroders for 18 years was that the big asset manager, we had a lot of assets under management on the team. We had a lot of big stakes, and a lot of companies beat a path to our door. And so that lots and lots of companies came through the doors. And that was a great place to just see the field. Since then, I've had a much more focused approach. So it's not been so vital to see the field. So I think now, with that background knowledge, a lot of the ideas come from things I've known for many years. I'm wary of investing in IPOs. Buffett's got comments to make on that, and things are very much in the shop window there at the time of IPO. But I will look at them to make sure I know what the business is that's arrived on the market, in the hopes that in time, there might be some new ideas coming from there. And I do screen for things, and I do look at businesses that I haven't met before. I mean, a couple of examples in the fund which I hadn't met when I was at Schroders because they weren't around then. One is Strix, the kettle controls company, and that popped up on a screen, and I did some work, and actually I first met them when I was out of the market on gardening leave. I met them at one of these investor shows, and thought, yes, this is everything I think that the numbers tell me, and started to sort of take it from there. The other company that's done very well is Kainos, which is a software and services company doing digitalization for UK government, and also implementing software called Workday for corporates. And I met Kainos at a dinner at an Oxford college on one of these broker 2-day trips. And I was actually introduced to the chief exec by a competitor who said, Rosemary, you ought to meet this guy. He's got really good business. And then I looked at it and thought, oh, yeah. And since I first bought that for Free Spirit Fund, it's an 8-bagger.
Wow.
Yeah. Wow. In 4 and a bit years, probably. So that, you never know, I think, where the ideas are going to come from. There's no one place.
And are you limited in buying into a position that the liquidity means that you have to wait for a placing or something in order for you to get the position size that you want?
Well, so far it hasn't been an issue. I mean, the fund's now about 30 million. And so with about 30 holdings, you know, the math, as they say, is easy. And the inflows are steady into the fund. So, you know, I've been able to build up holdings steadily. I think the fact that, you know, the minimum size of market cap is about 150 million also helps. I'm not trying to, you know, buy into a micro cap. I don't see placings as a likely source of stock for most of my holdings because actually all but about 6 of them have got no debt at all and probably won't need to come to the market. They generate so much cash that they'll just use the cash to do what they want to do. There are sometimes director placings, you know, when you've got people who are, you know, on the way to retirement or whatever, and sometimes that can be useful. But I don't need a placing, certainly at this stage, to get positions in companies. Well, it's worth saying that at this point, actually, that I have an approximate aim to not go over 500 million as a fund size. At 30 million, that looks like, you know, a tall order, but people, I think, want and have a right to know that from the outset. And the reason for that is exactly your point, that I don't want to get into a position where I can't access the companies I want to because the fund is too big. You know, there comes a point where business considerations of a fund management house can take over from the interests of the fund investors, and you see it happen a lot, in my opinion. And you know, you start to increase the number of holdings, you start to increase the size of your stakes in companies, and you can start to be forced up the market cap scale, and you see it again and again. And I think I'm just trying to say that I don't want to go there, if at all possible. And I say that as the person that seeded the fund.
And moving on to the outlook, you mentioned inflation. Are there other aspects like that you are factoring into forward planning and general considerations in the outlook for the market?
No, not really. I am very much of the view that I can't forecast the market, and I don't look at macroeconomic research. I think there's enough to be doing, focusing on the businesses that I'm investing in and their specific market opportunities and how they're tackling that. So that saves a lot of reading. I mean, I'm not saying I'm not aware of, you know, global risks, you know, hearing things on the news, but I would tend to view, as they say, a sell-off as an opportunity to buy into good businesses lower down, rather than an excuse for sort of a panic. I just simply don't try and suggest where I think the market's going, because I haven't got a clue.
Rosemary, thank you very, very much indeed, and lots of luck for the next year. Let's hope it's as auspicious as the last year, and hopefully we'll catch up again with you soon.
Thanks, Tamsin. Appreciate it.
And to all our listeners, find more interviews like this at piworld.co.uk, both as a video and as a podcast. We look forward to seeing you again soon.